Welcome everyone to another episode and video of Mere Finance. Today we're going to talk about how interest rates could help us to strategize in our portfolios, but using some sectors, so the energy and the home builder sectors, which are very prone to interest rates, but also to the current economic and political environment. So we're going to observe how we can use both of these sectors to probably try to create excess return in our portfolio. So don't forget to subscribe and let's get ready to start this new video. So in theory, what I want to show is how the yield curve for the United States has been inverted, like the slope from the 2-year to the 10-year has been inverted for almost 58 days. It's the third longest inversion in history, right? So this is troublesome because this shows that it could probably cause a severe recession. So it's not only that it's inverted, it's also the length and the slope that is inverted. So currently it's sitting at 33 bips. So the 2-year point is 33 bips higher than the 10-year. Also we have the 5-year, and the 10-year is inverted at 16 bips, and the 3-month to the 10-year dropped 9 bips last week. So now it's only a 15 bips difference. So if the 3-month tends to go higher by only 15 bips and the 10-year remains constant, we will see an incredible inversion of the 3-month to the 10-year, which is a little concerning. But if you see in the graph here in the US Treasuries, you can see all of these periods here in the bottom right. At the end of the graph, we can see how interest rates were basically zero for the last 3 years, so from 2019 until now 2022, and look at that big steep, almost surpassed what we saw in 2018. But since 2010, we have seen a period basically of zero interest rates. So this big interest rate spike is going to bring a lot of issues in the market because it's a sudden spike. People are not ready, and it's a lagging indicator, right? When interest rates rise, usually it takes 3 to 6 months for the whole economy, for the credit markets, for the bond markets to accommodate, and for the real economy to start looking at what it should change. So in all of these times, for example, when we see interest rate rising, home building and energy sectors also acted in different ways. And especially in the 70s, like that whole decade of 1970, energy was an extremely profitable sector to be, and home building wasn't that bad, but because people were still building, but it was difficult to get mortgages to build houses. So we're going to see how, with these spikes in interest rates, we can assess our portfolio on the energy and home building sector. And if we can see some probabilities, it seems like the Fed Reserve is going to have interest rates, like the Fed fund rates, will end up being around 4% by the end of the year. So currently, by December, in the future 3-month average for Fed fund rates is around 3.82 by the end of the year. That's what the market is assessing. But if we have the possibility, so how we calculate that? So basically the federal funds chart, we have the target rate and range. Currently is from 2.5, from 2.25 to 2.5. So we go into the middle, which will be 2.375. And then at the end of the year, we see, all right, at the end of the year, the market is pricing at 3.82. So we subtract the middle of the current target, and then we said, all right, if it's at 2.35, let's see if the Fed is going to add another 150 bips, 150 bips, or 1.5%, which will basically end at 3.9, almost 4%. There is a 96% probability that this happens. So as we can see that rates are going to keep rising, with that, what does that mean for the sectors that we're talking about? We will find this out. So this is a little worry. Well, before that, A lot of people, this is actually from Mark Meldrum. He's a great CFA prep, so I took this graphic from him, so all the credit to him. Also, in the comments, in the description of this video, is the link to his video where I took this off. So this is all creation of him. I just added my own interpretation of it. So basically what this is the rings of risk. So retail investors like you and me, people that we don't manage big pension funds or endowment funds or some sort of billions and billions of dollars under management, what we do is we try to have our own portfolio and try to beat the market, or at least have good returns. So what we usually do is that we go all in securities. So we just buy different stocks. But if you read, well, this is another conversation for another day, but it could probably be a conversation on whether is the market efficient or not. Can you generate excess returns or not? So by market, we mean every single sector. So currently in the United States, in the S&P 500, we consider to have 9 different sectors: healthcare, technology, staples, energy, home building, and so forth. So if you want to invest in the market, you will be buying all of those sectors. But what retail investment do, they just buy a stock without considering anything about the market. So basically in the market we have the 9 sectors, and within each sector we have different industries, right? In the energy industry we have oil and gas equipment, oil and gas transportation. They could be in the same sector, but as a company you are dealing with different parts of that industry. So if you think that rates are going to go up, or if a recession is going to go up, then you have to assess how is that sector going to behave. You cannot go directly into the security. Usually technology goes down when a recession is in place because interest rates go up, and then technology, which is new, needs that credit, needs that venture capital in order to operate. So if rates go up and recession occurs, then technology will probably suffer. A staple usually goes up during recessions because people still go into that sector. Same as utilities, something that everyone needs: water, electricity. People need that. So during a recession, those sectors are stable. So in this case, and also in this case, we're going to see how we should use the energy and the home building. So first, if you go into the market and you say, all right, some sectors might benefit from it. All right, that's good. Let's see. For example, our thesis is that energy will do well in this environment. So we go into the next group. All right, do we think that oil transportation will do better than oil exploration? Say oil exploration isn't that great because the governments are like, oh, fossil fuels have to be banned and this and that. So oil executives probably say, no, we are not going to spend on exploration. So probably transportation will do better. And if transportation does better, then we have to look into that industry group and see, like, okay, which are companies that are doing better than their peers, and then we go from there. But if you think all companies are exposed to the same risk, then what's the point of taking a chance in one company? Just buy the industry ETF if there is one available. So in order to do that, what we do is analyze it. So basically we're analyzing the XLE, which is the ETF, so the exchange rate fund for energy, which seeks to attract the performance of the index. So the fund employs a replication strategy. It generally invests substantially, at least 95% of its total assets in securities comprising the energy index. And this index includes companies that are in oil, gas, consumable fuels, energy equipment, energy services. So by GICS. GICS is the one that provides us with the industry classification. So the XLE tries to invest on those companies that are within the sector in energy. So let's see. Oil. By the U.S. Energy Information Administration, this is the 5 to the left, right? This is the 5-year range on which million of barrels, so that's the range. See how we are weekly this year, we are way below the median, and we still don't see a spike. We still don't see the weekly trend going back to the 5-year range, which is worrisome, right? But we also have in gas the same. You can see how the 5-year average, which is the red line here at the right, is above the lower 48. So that means that our current storage is way lower than the 5-year average. Hence, the prices will keep going up. So, and that's the range. And we are all, look at the range in the gray. We are in the blue. So basically, we are almost in the minimum range of the 5-year, which is pretty worrisome. Although this industry is cyclical, but still, we haven't seen an increase in gas yet. Some of the ETF holdings are usually Exxon, Chevron, Oxy. So you can see how exposed you are to Exxon, which is the biggest oil company in the United States. So you can see if when you invest in this ETF, you're actually investing in 21 different companies. But as the rates go up, as I was explaining, your capital expenditures are going to go down. And you don't want, and oil executives, they don't really want to invest because they're being, in every country, considered traitors of the environment, and like they're weaponizing our future. You know, I've spoke multiple times against all these fossil fuel deniers and all these green policy people, but no. Oil executives are not going to invest if they're being demonized by everyone. And then winter is coming. As winter comes, Europe and the United States needs that gas and that oil to warm their houses. So that's why we think as rates go up, capex will go down, and as the winter goes up, the demand will go up. So it's kind of worrisome in that sense. But if we go into the Homebuilders ETF, we can see we have to start first with the sense that the interest rates, the mortgage rates here in the left, are at 5.73. All-time high from the last 2 years is 6.11, which is pretty high. Remember last year people were buying houses at almost 3%, 2.8. I have a friend that bought a 2.8 15-year mortgage. So now we are sitting at 5.10 for the 15-year, 5.73 for the 30-year. Is extremely high. You can see the range. 2.92 was the lowest. 2.37 for the 15 was the lowest. And as you can see, as rates go up, well, it's harder to buy new houses. If it's harder to buy new houses, then demand goes down. And sentiment is an all-time low in the last time. So as sentiment is down, rates are going up, so it's kind of hard to refinance or get a mortgage. Material costs are also going up, have been going up. So I know a lot of contractors, they have been struggling because they set a price, they set a quote, and because prices go up in transportation and in the materials, or there's simply not enough materials to build a house, or it takes 3-4 months to get those materials, then they're almost going underwater. Because let's say they sign a contract for $300K and their materials are actually, with all the labor, cost $350, they're actually losing $50,000. So why will a contractor go and build a house? It's better to just relax a little bit while the market comes down, because they're not able to budget correctly, and this can create a lot of issues for them. So because of those issues, then home builders also will go down, and you can see all mortgage applications are down 1.2% month over month. So home builders also, here in the graph on the left, drop in order show high end of the market hit by weakness. Extremely. We were at 3,000 units. Now it's almost at 200. Unbelievable. And also US new home sales went all the way from a million to almost 400,000. So it's kind of worrisome. Here are the holdings on the left that you will be buying when you buy either ITV or XHV. So we probably will think you should short this sector, and we will explain why from a quantitative standpoint of view. So if you see how interesting is that We have the energy and the home builders ETF and the rolling correlation. Look at that correlation is so low when interest rates are pretty low, right? You almost see a rolling correlation of 0. From 30 to 40 bips. That's around the correlation, which is pretty low. And as rates go up, as rates went down during the pandemic, you can see that huge spike in correlation because everything was moving in the same direction, right? Energy, every sector was crashing. But now that rates are going down, you can see correlation going down again in both of these. So this actually provides us with our thesis that correlation between these two sectors is actually pretty decent. It's below 50, which helps us diversify. But in this time, as rates really go up, because since, well, this graph is from 2011 until now, we haven't seen a big spike in rates. So we're going to see, I'm pretty sure that as rates keep going up, we're going to see that rolling correlation just completely plummeting down, which provides great way to strategize our returns. So here are the different industries for the XLE, which is integrated oil, gas, exploration and production, storage and transportation, equipment and services. And for the home builders, we have home improvement, home building, building products, home furnishing, retail, home improvement, retail, household appliances, yes, like your microwave and your fridge, cellars, they also are in this industry, and the home furnishing. So not every single industry has an ETF. So we will try to compare the ones that had it. This is a 60-month analysis that we did. And you can see how the lowest correlation is 0.44 from the gas equipment to the home builders ETF. The issue is that gas equipment is actually down 15% this year. So imagine, even though the whole energy ETF is up 6.93 annualized return, including this year, the equipment and services is down. Why? As we said, capex goes down, so capital expenditure goes down because oil executives and energy executives don't want to explore because they are being vilified by politicians and different groups. So this explains a lot. This is why you need to understand that you can actually go into each industry and then you can take each sector and take advantage of different industry. So after analysis, I think the best way is that we can just simply buy the energy sector ETF versus the home builders ETF. Don't even go into the sub-industries or industries. As you can see, from the ITV to the XLE here on the top left, 0.46 correlation, which is pretty good. And both have an annualized return of 13.33% in the last 5 years and 6.93 in the last 60 months, in the last 5 years. So as interest rates go up, we will see that energy cannot be modified. Like, interest rates don't really affect energy prices too much because that's a different market, nor even food. But home construction and home building will definitely start plummeting. And when it plummets, we can definitely assure that home builders are going to suffer, and then energy sector will continue to have great returns. So in the future, we are going to create an index, right, that balances these two sectors based in other variables too, like lumber prices, lumber to gold ratio, and also in interest rates. So stay tuned. We will create a great index so we can try to generate alpha, and we also are going to backtest our strategy to see how we can take advantage of only these two sectors in order to beat the market. So thank you very much for your time, and I hope this material was of great aid. Goodbye.